Welcome back to Strongman Personal Finance. Smooth, baby. We got to talk about Paramount Global. That's right. This is a sponsored video. If you want a sponsored video, you send me $50 and I will make you a video on whatever you want. Doesn't have to be a stock. Anyway, we're going to talk about Paramount. Is this a buy? Is this a sell? I'm not going to tell you. I'm just going to look at the financial statements. So what is Paramount Global? Well, I know what this company is because I've heard of this thing called Paramount Plus. How have I heard about that? Well, I have this thing called Walmart Plus. And if you have Walmart Plus, at least back in the day when I had it, you actually get Paramount included with it for free. So Paramount has some kind of deal with Walmart where you get some free shows, okay? It's pretty cool. So let's go ahead and read a little bit more about the business. They operate as a media and entertainment company worldwide. They operate through TV media, direct-to-consumer, Paramount Plus, and filmed entertainment segments. Right off the bat, highly competitive industry. There's 100,000 different media companies, and there's 100,000 different streaming companies. And from what I remember looking at the financial reports, we'll look at that in a second, the only revenue that's growing is their Paramount Plus, which I wonder how much of that is just due to their partnership with Walmart. But some of the brands you may recognize, and I recognize these: CBS, okay, Network 10, Channel 5. What is this? What is a channel? I don't even know what a channel is anymore. Telefe and Chile Vision. They're appealing to the Hispanics, I guess. Networks, Paramount Media Networks, Nickelodeon, BET, which, oh, by the way, they just tried to sell, and CBS Sports, okay? So obviously everybody knows what freaking CBS is and what Nickelodeon is. Back in the day, Nickelodeon was a big deal. I don't know if it's a big deal now. So let's go ahead and look at the stock price over the past 5 years. Now, this looks like a big wing-a-lang, dang-a-blang, blang-a-blang. And apparently there's this guy named, what's his name, Bill Wang or whatever his stupid name is. There was some clown that used massive leverage and bought a bunch of stocks. You see these with a couple different stocks where you see this massive vertical line, kind of like NVIDIA, and then it just plumps back down. That was old Billy Wang there with his little hedge fund or whatever that clown was doing. Take my money, bro. So let's go ahead and dive into Paramount, okay? Market cap of under $10 billion on revenue of $29 billion. Wow, that's a pretty small market cap for the amount of revenue. Is it cheap, bro? Net income of negative $1.17 billion. Not bad, okay. Shares outstanding, we'll see that in a second. EPS, negative. PE ratio, negative. And forward PE of 13. For a turd like this, excuse my language, a forward PE of 13? Okay. And they got a tiny, cute little dividend. So let's go ahead and check out the financial statement. So this company has spinoffs and mergers and this and that. So the income statement almost, you can't really compare it like you would with other companies. There's so much going on. This company used to be, Viacom, CBS, and before that they were separate, and then they came back together, and then they were separate. There's so much history to this company. And now they're trying to spin off BET, and they just sold Simon & Schuster, the big publisher, Schuster, however you freaking pronounce it, I don't know. But they just spun that off as well. So this business is like in massive transition. It's in massive flux. So, but we can look at it anyway. So, revenue is consistently grown. You see, look at that random revenue spikes. Revenue, I guess, is up over time. Let's go ahead and look at margins. So, margins have been massively compressing recently. Operating margin is negative. The last 2 quarters, they've had negative operating margin. They've had negative profit margin, which is your operating margin, minus interest and minus taxes. And they have negative free cash flow. They've had negative free cash flow for the last 4 quarters. Wonderful. Okay. Let's go look at the balance sheet. Or actually, we'll save that for the actual financial report. I don't like looking at the balance sheet on here because you don't get enough details. So let's go look at the statement of cash flows. Negative operating cash flow for the last 3 quarters. Okay, that's not that good. Capital expenditures. It seems like pretty standard. Acquisitions. So it looks like they had some kind of divestiture at the end of 2021. When you see a positive number over here in this acquisitions, a positive number means they got a cash inflow. Positive means cash coming in on the statement of cash flows. Negative means cash coming in, except for up here in the operating section, but don't worry about that for now. But, yeah, you take a note, Joseph Carlson. But they had some kind of divestiture, okay? Change in investments, whatever. Let's look at dividends. So the dividend isn't even growing. So if you're like a dividend investor, I mean, why would you buy this as a dividend investor? Don't you want like growing dividends? Don't you want like a dividend gym? Shares, they're not really buying it. They haven't done anything. They haven't issued shares. They haven't bought shares back. And debt. So it looks like they've paid off some debt. Basically, the numbers are, it's hard to tell historically because this company is just like, it hurts my head because there's so much, they're spending off this and they're acquiring that and they're doing this and they're doing that. It's all over the freaking place. So overall, I'm not very impressed. Okay, I see negative operating cash flow for the last 4 quarters. That's not good. You want positive operating cash flow. Sometimes it could be a timing issue. Sometimes companies, maybe they buy a bunch of inventory at the end of the quarter and then it works out at the end of the next quarter. But this company has consistently had negative operating cash flow for the last 4 quarters, excuse me, which is not good. Okay, they're definitely they're trying to spin off stuff that they think is turds, probably. Valuation, everything's negative. I mean, I don't know. I mean, just from a accounting standpoint, I don't like this business. And it's very complicated. Now, what's going on? So like I said, they tried to sell their stake in BET. But apparently the whole thing fell through. And they didn't go ahead and do that. But they did sell Simon & Schuster, the big publisher, to KKR, which I believe is like a private equity firm or whatever. So you're going to see that on the next financial report. You're going to see a massive inflow of cash. So when you look at the financials, we'll go see the balance sheet in a second. If the cash looks low to you, I wouldn't necessarily freak out, okay? Depending on what the consideration was. Maybe it could have been shares, cash, whatever they freaking gave to Paramount to sell Simon & Schuster. But they are trying to divest a bunch of different businesses. Now, here's the announcement. I wouldn't have looked in the 8K. If you want to see events that are going on, because when you look at a financial report, you got to keep in mind, the financial report is as of the most recent report date, which I believe was, what, June 30th for this company? It's now August 24th. You need to go look at the SEC, or you need to go onto Investor Relations on the Paramount website, and you need to go look at the recent events. Usually it comes out as like Form 8K is where they announce new things that have gone on with the business. You wouldn't have seen that if you just went ahead and went, oh, value my value, and you just looked at this. You wouldn't know that they sold Simon & Schuster, and you wouldn't know that they failed to sell BET, Black Entertainment Television, I think. Check out the pinned comment below and join our Discord community where you can ask me questions directly via text, and if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment, join the Discord community, and let's make some money. I don't watch that, okay? I know, shocking. So this is basically Paramount Plus. This is what comes with your Walmart subscription. And this is basically the only shining star in the company. But you got to keep in mind, they're still not making money off this. And when you look at the, I think I had it somewhere. Maybe it got rid of it. Oh, here it is. Look at how big Paramount Plus. You see that little blue dab on the top? These are all the other streamers. Disney Plus, Poop, Peacock, HBO Max. I just got demonetized. Hulu, and Netflix. Okay, this is cute little Paramount up here. So when you see like massive revenue growth, oh my God, wow, they're taking over. No, they're still a small fry. This is as of Q1 2023. But look at the competitive landscape. Okay, this is their fastest growing segment, their streaming service. And get out of here. What do you want with me? And it's losing. It is losing money, and it's a small fry. Okay, it's a highly competitive industry. So let's go ahead and check out their 8K. So when they announce their quarterly reports, they usually, do some kind of announcement with their 8K. So here, yeah, they released this August 7th, 2023 for the quarter ended June 30th, 2023. So this is the report as of June 30th, 2023. So let's go read what's going on with Paramount. Paramount Plus grew revenue 47% and reached 61 million subscribers in a highly competitive industry. Paramount Plus and Pluto TV global viewing hours increased 35%. And direct-to-consumer advertising revenue, 21%. So they make money through Paramount Plus through subscriptions, and they advertise on it as well. And I suspect once you rates get cut and it becomes clown market again, I'm sure ad rates will go up and I'll make a fortune off YouTube, and Paramount Plus might benefit from that. So let's go ahead and look at their disaggregated revenue. Their total revenue was $7.6 billion. TV and media, which has dropped 2%, is the lion's share, $5.1 billion of revenue. Direct to consumer, this is Paramount Plus and the ads that they have on there, basically. 40% increase. This is the one shining star. Filmed entertainment is down 39%. I believe I saw in the report it's because of Top Gun. They had like a huge spike because of Top Gun 2 or whatever. I still haven't watched that because I'm a loser. But overall, they have negative operating income, okay? So their fastest shining star is a pretty small portion of their revenue overall, and it's unprofitable. But hey, at least something's growing, okay? Let's see. So subscription revenue. So yeah, like they say right here, they make their subscription revenue is growing pretty quickly. Probably because of Walmart, I'm guessing. And advertising revenue is up 21%. But you can see overall that it's unprofitable. So here's some weird adjusted operating income before depreciation and amortization. So this is, I think that's what that means. I hate these stupid metrics, okay? So even if they don't include depreciation and amortization, remember, depreciation is spreading the cost of an asset over its useful life, a tangible asset, and amortization is spreading the cost of an intangible asset, trademarks, patents, copyright, stuff like that, over its useful life. Even before that, they were still unprofitable, okay? And they're losing money on that. They're losing money. So I don't really see, I mean, I guess they're improving their margins a little bit. You know, they're losing less money, but they're still unprofitable, and it may take a couple more quarters for that to become profitable, or even longer than that. So here's their TV revenue. This is all the shows: CBS, Showtime, MTV. This was cool when I was a kid. Okay, BET. Obviously, I don't watch that. Paramount, International, and Nickelodeon. Okay, these are pretty. I recognize all of these brands. These are not like bussy brands. These are big time brands. Okay, but they're still not doing that well. So we can see their revenue's down 2%. Advertising is down 10%. Affiliate and subscription is down 2%, and licensing is up 17%. So that's the one bright shining star. But overall, it looks like they're making a profit before depreciation and amortization is what I think that freaking thing means. But overall, I mean, it's not doing that well. Okay, it's really not doing that well. Filmed entertainment. Okay, I believe this is because of Top Gun. Revenues decreased 39%, driven by lower theatrical revenues due to Top Gun Maverick. Excuse me, I thought it was Top Gun 2. I'm a moron. Okay? And their profits fell as well. But apparently, with this clownish metric, they're still, quote-unquote, making money. Wow. So let's go ahead and look at the financial statements. So we looked at them briefly. Let's see if there's anything that jumps out at me. So one thing I did notice is that there was this programming charge. And I'm not this looks like a one-time charge here. Oh yeah, so they had a one-time charge here for $700 million, which won't be there next quarter. And to be honest, let's see, where was the operating income? Without that one-time charge, I guess this must have been some write-down they had to do. Without that one-time charge, they would have had positive operating income, and they would have been profitable. So keep that in mind. Hopefully that's a one-time thing. But we can see operating expenses have grown while revenue has decreased. Wow. Year over year. Selling, general, and admin has increased. Depreciation, amortization. So basically all their expenses are increasing, and their revenues are decreasing. So they had one big kaboom with Top Gun. Amazing. Interest expense, not up that much. Interest income is up. Most companies have a big improvement in interest income because of interest rates, but that's not going to last forever. A gain from an investment. Wow, that's a one-time thing. I would never count that. And overall, they had a loss of $299 million on $7.6 billion of revenue. So they're losing money. One-time charge. one-time thing. But overall, without those one-time charges, they would have been profitable on a GAAP basis. So you can keep that in mind. Let's see. The balance sheet. Here's what I really want to see. So let's see how things have changed. So cash has gone down, but remember they had that sale of Simon & Schuster. So that cash will probably be a little bit nicer unless they spend it before next quarter. Receivables are down. That kind of makes sense because revenue's down a little bit. Programming and other inventory, that's up. That's just spending on programming. Let's see. Prepaid expenses. So overall, nothing crazy. A pretty big drop in cash, but I think they're going to be fine, at least for next quarter. Okay. Long-term programming. Goodwill. So they had a tiny little acquisition. We know that because goodwill went up. Nothing crazy though, or they didn't pay a lot of money extra for than the fair value of the assets. Intangible assets are down a little bit. Could be amortization, leases. Let's see, other assets. So overall, we have total assets of $55 billion. Now let's compare the current assets to the current debts. So they have, wow. They run a pretty tight ship here, okay? So if you factor in their cash and receivables, that's about $9 billion of money they have or will have very soon as of this date. And they owed, they have enough money to pay their short-term debts, it looks like, especially with that sale, because they have, as long as they collect those receivables pretty quickly, they should be able to pay their bills, no problem in the short term. So overall, their current ratio is not negative, and they have a healthy amount of cash and receivables. So I'm not super worried about that. And with that sale of Simon & Schuster, if it was all for cash or big cash amount, they'll be fine. If it's a receivable, I don't know. Okay, let's compare long-term assets to long-term liabilities. So nothing, they have a pretty significant amount of goodwill, but it's not like mind-boggling like other companies. Let's see, long-term debt. Wow. Okay. So they have $15.6 billion of, that's a lot of debt sitting on the balance sheet. And most of their assets are programming. So most of their long-term assets. So I mean, they're going to generate cash flows from these, but that's a decent amount of debt. That's not pretty to look at. Okay. I would look into when that's going to mature. Let's see if there's anything else on here. Nothing crazy. Shares, they went up a little bit. Could be stock options, maybe. Treasury stock has not changed, so they haven't bought back any shares. Retained earnings went down. That means that they had a loss over the last 6 months. And accumulated other comps, so they had some kind of comprehensive income because it actually went less negative. Comprehensive income is income that skips the income statement and goes straight to the balance sheet, basically. But it shows up here. And you want to pay attention to this because, remember that freaking bank that went under? The clown bank? As Silicon Valley Bank? If you had been looking at this, you would have seen some issues. But overall, I don't see any major problems. So their total equity is 21.6, but they have a lot of intangible assets. So if you didn't factor in their intangible assets, they would almost have negative equity. So, interesting stuff. Statement of cash flows. Let's see. Depreciation's up a little bit. Programming, so they had a Wow. So this is a non-cash write-down, because when it's added back, that means it was an expense that was non-cash on the income statement. They had a huge write-down of something. Not sure what that was, but that's concerning. I would look into why they're writing stuff down. Because if they're writing stuff down, they're doing that generally because they don't expect future cash flows to be what they thought they were. Just saying. Let's see. Stunk-based compensation, nothing crazy. Gain from investment. Okay, so the big thing that jumps out to me is this programming charges, which is a write-down. So overall, they had negative operating cash flow. And they've had that for the last couple of quarters. Investments, they bought some investments. They spent a little bit of money on capital expenditures, and they used $225 million in capital expenditures. So net on net, they burned $626 million overall in their operations, their core business, and in investing. Let's look at their financing. They didn't even pull money from financing. They're paying dividends. Wow. Look at that dividend growth right there. Man, that's some growth, my oath. From 315 to 317. They need to stop paying the dividend. Pay off some debt. What are you doing? Okay, so they're paying dividends. They have preferred dividends. They pay those get paid first. Oh, by the way. Let's see. Payments are not controlling it. Okay, so basically they just spent a bunch of cash this last 6 months. So I'm not surprised they're divesting because they probably need some money. But overall, like, I don't know. I don't like this company. Like, they have a pretty significant amount of debt on their balance sheet. Their core revenues, their actual programs, they're not growing. And the only thing that's growing is Paramount Plus in a highly competitive industry. And I personally don't watch it. I have it for free, and I still don't freaking watch it. So that's my thoughts. I mean, like, I don't know why. Like, why buy this when you could buy an index fund? You know, maybe the stock will vertical line. I don't know. But, like, why? Why take the risk? There's so much changing with this company. They're divesting BET, or they're trying to. They just sold Simon & Schuster. This company's freaking crazy, okay? So that's kind of my thoughts. I don't know what else to say. Paramount, wow. Mind blown. Old Billy Wang here. Wang, ding-a-lang. This is when you should have sold, bro. Actually, you should have bought up here. All right, right up here. You buy up here, okay? And then you sell down here. All right, have a wonderful night. Cheers.